Hey, what's up, guys? Shravan Venkatraman here. In this Zen and Alpha podcast episode, we have Mr. Neil Parikh. He is the CEO and chairman of Parikh Financial Advisory Services, otherwise called as PPFAS. It's an asset management company now responsible for close to three mutual fund schemes that are very well respected in the market. He is also the son of late Mr. Parikh, who is a highly revered value investor. His content, thoughts, and books on behavioral finance is mind blowing. If you have not already seen it, his lectures are all there on YouTube. You should go check it out. PPFAs actually started off as brokers in the 1990s and thereafter became a portfolio management service. Until 7 to 8 years back, they were operating with a PMS model, after which they closed their PMS operations to start the mutual fund operations. In this chat, we discuss at length about the history of the fund, why they switched from a PMS model to a mutual fund model, and why they don't chase growth at all costs like other mutual fund companies. And you'll also learn about how a mutual fund operates, how they make their buy sell decisions, and more information regarding mutual funds from this episode. Without further ado, let's welcome Mr. Neil Parikh.
Okay, so thank you, Shravan. Thank you for having me on your show. A little bit about PPFAS and how we got to this point today, and a bit of a history. So the company was started by my father, Mr. Parikh. I'm his son. I'm a second generation entrepreneur. So it began with my father. We started off as brokers, and once the economy opened up in the early 90s, empanelments happened in the sense that FIS came, mutual funds came, and we were empaneled with them for the simple fact that we were actually the 13th broker for UTI at that point. In the late 80s, UTI was the only institution.
Okay.
And we were lucky to be the only 13th empaneled broker with them. And that was because back in the day, my father really believed in fundamental investing, and nobody was really doing it at that point. So what he would do he would prepare one-page reports, or he would have cutouts of the Economist or any interesting articles and keep sending it to the CEO of UTI at that point. It was a struggle in the sense that he didn't get it immediately. He did this for a couple of years, and then finally, the person at the head of at UTI said that, okay, this guy's trying to do something different here. Let's make him the 13th broker. And it was very hard to break into the UTI as an panel broker at that point. So we were lucky there, and that's when we got started up. And when the economy opened, we were there and we got empaneled. By late 90s, about 1996, we got our PMS license. And at that point, we began to think that, if we are proponents of long-term investing, value investing, then broking really doesn't go that well, because in broking, you need to make people buy and sell very regularly. And we are talking about here a buy and hold kind of strategy.
Correct.
So we realized that managing money was kind of our forte, and that was our calling. So from 1996 to 2012-13, we ran the PMS. Over that time, we closed down all our other businesses in terms of the broking, merchant banking, debt markets, and we did this so that we could concentrate only on the AMC business, which we began in 2013. So the fund is about 7 years old, but our experience in money management is more than 25 years old. Now, why did we move from PMS to a mutual fund structure and we closed down all our business? Number one is when we were managing people's money, we didn't want any conflict of interest in terms of broking and other activities. So we said that we'll close down everything and we'll only concentrate on what we are passionate about and what we think we want to be masters in.
Okay.
At that point, after post the financial crisis in about 2008-9, so in 2010, we really began to start thinking that the US markets were really attractive, and we want to participate in this market. And we were getting some really futuristic companies, your tech companies at throwaway valuations. Even some other great blue chip companies were available very cheap, and we said that we want to participate in this market. The PMS structure didn't allow us to participate in foreign stocks,
Okay.
So what we did at that point was we started opening individual accounts, brokerage accounts for our select HNI clients who wanted to do this, and opened the foreign accounts for them and started advising them on the stock selection. But this was operationally challenging. Tax-wise, it was tax inefficient. and also the fact that it wasn't a very scalable model, and if some and then people wanted to hedge the currency and some people didn't want to hedge the currencies. Now if you're going to hedge the currency and the rupee starts depreciating, then you have to always, call up the client and say, sir, margin call, please pay up. And these are all H&I professionals, who are
Correct.
traveling around the world, and it would be more of a irritant for them than anything else. So we said that, okay, this is really not working out that well for us. So what's the better way to go about this? And the mutual fund structure was something that we looked at. And we're like, okay, wow, this structure could give us a 65-35 kind of structure in which 65% can be invested in Indian equities, and we have an opportunity of investing up to 35% outside the country. And this really appealed to us, and nobody was doing it. We said that there's some weight in this when we do it. Also, tax-wise, it would be very easy for us. Operationally, very easy. Scalable model. So a lot of these things came in together, and that's when we started the mutual fund in 2013, and we closed down everything else. So and now it's been 7 years to the mutual fund. So here we are.
That is quite a story, actually. So, when you had to transition from being a PMS to a mutual fund model, what kind of issues or hurdles did you have to come across in order to get to the place that you are right now? I mean, were there any regulatory hurdles or legal hurdles that you had to face, or some other issues that you had to face in your way?
Yeah. So actually, uh, when we got in, and we were the lucky one. We were probably the last of the mutual fund who got in with a net worth of 10 crores. That the requirement for a mutual fund at that point when we got our license in 2013 was 10 crores net worth companies to have.
Okay.
Okay. So we got the license, but then a year later, that limit was changed from 10 crores to 50 crores.
Oh,
And we had 3 years to get to a net worth of 50 crores. And so that was a bit challenging in the sense that all the profits that we made were plowed back into the company to increase the net worth. We really didn't want a foreign partner or a joint venture or any of that, because that will take away our freedom and our independence. So we
correct.
wanted to do this very organically. So the first years were very challenging in terms of getting to the net worth. Also, we could not spend money on marketing or any other activities that we wanted, or branch opening, or even if for that matter hiring people, or to even sometimes we had to delay getting the advanced systems in the office. So the first 3 to 5 years was actually challenging. Also, the fact that we weren't a brand name at that point. I mean, it's not like we are a brand name right now, but and we didn't have any visibility. We didn't have a brand name or a detailed recall, as such, like the bigger mutual funds had. So it was more of a struggle for us. For us, it was about building a track record of the first 5 years. 5 year track record should be good, and then we would think that then we would see. So we thought that the first 10 years actually would be a pretty big of a struggle. Uh, and the first 5 years was surely a struggle. We didn't AUM didn't rise, but we really ran a tight ship that time because of the net worth criteria. So the regulatory hurdles were there, plus not having a brand recall and visibility were challenging in the beginning. But I think we concentrated on what we could concentrate on, which was our internal systems, our performance, and our communication to our clients, having AGMs for our clients. So we tried doing something different. We had a differentiated model also on the 65-35 that nobody was doing. And over time, people started appreciating what we were doing. And I think over the last year, we've been getting a bit of the fruits of the labor, as you call it.
Right. Correct. Correct. So, when you talk about net worth, does it mean asset under management or just the promoter net worth alone?
No, it's the company net worth.
Okay, got it. And once you started growing,
Yeah.
how did your fund philosophy evolve? I mean, I want to understand how the fund's philosophy has evolved since you were in the PMS model to the transition from PMS to the mutual fund model up until now.
So, really, the investment philosophy hasn't changed much. What it was about value investing, what was important at that point continues to be important right now. What has changed is that we've been using more of technology, more of the tools to sharpen the research process, and to quicken the screening processes, and having information got to us in a better manner, so that we can meaningfully do more research and cover more companies. So investment philosophy hasn't changed. The methodology or the tools we used have obviously evolved over the last 7 to 10 years.
Okay, can you give an overview of what your approach to investing is right now? I mean, what kind of processes you go through and how you filter out stocks that you don't want to invest in, and an overview of the research method also.
So I'll just keep it a bit basic here.
Yeah.
Won't go to too much of the quantitative details, but we have a checklist. Okay, so we have a checklist which is more of which eliminates more companies, right? I mean that's what the checklist is. It eliminates companies, and we're left with about 400 to 500 companies. Okay, which is our, what do you call it, circle of competence, as you might call it. Okay,
Okay.
of 400 to 500 companies which are Indian as well as global. Okay, so they're not only Indian but worldwide. What are the 500 companies we think is our circle of competence? Through some filters, these get filtered. That filters, one main thing is the management quality. We pay a lot of weightage to the management quality here. Okay,
Okay.
uh, and this is again, it's not a very objective way of doing, but it's a pretty subjective way, and each one will have its own way um, uh, about uh, uh, about management quality and how to rate them. So this is a subjective call which we do it internally. Then we want companies with high return on investments, high ROC, high ROE. We want debt as low as preferably debt free or very low debt companies, high cash positions. Because we've seen that when things get bad, like you saw in the last 3 or 4 months, the companies which have cash on the books are able to really see off the tough periods, can actually grow, can make acquisitions, can grow market share in these tough times. So cash is an important thing. We are looking at companies which have certain moats around them, and recently, I think I think one thing that we are concentrating on and what we are thinking is that at least the big will get bigger, at least in the tech space, you are abroad, or the platform companies, those which are dominating will continue to dominate, so we're looking at that space also, and we are honing our research process towards some of those ideas that we have right now. And most of all, they have to be available at a price that we are comfortable with. So we are very disciplined about the price we pay for an investment. And sometimes if there are opportunities are not available, or they're not available at the price that we want, we are fine to sit on some cash at from time to time.
Correct. We also noticed that in this March, that PPFAS has invested in some securities that you already hold, and you've also made some fresh purchases. How did you guys sail through the March-April period and its volatility as a fund?
Yeah, so I think I like to a little before that. I think it all started in about 2017. Okay,
Okay.
in 2017, again in 2016, 17, we went through quite a bullish time for the stock market, at least on the mid and small cap space. In 2017, those were lists going higher and higher. Being a multi-cap fund, we have investments in small cap, mid caps, and large caps, as well as foreign securities. But at that point, we thought that valuations were a bit crazy, at least in the mid and small cap space. And we said that some of our stocks have also gone up a lot, and probably they don't deserve this kind of valuation at this point. So we started trimming positions in a lot of our stocks, in a lot of the companies that we have in at least the mid and small cap space. And we started building cash position, not for the sake of building cash position, is because there was no other alternative, for investments. So we didn't get too many opportunities at that point. So we said, let's buy that time. Maybe there will be short-term underperformance, but we're not comfortable buying at these prices. So we were as high as 30% cash at one point in 2017-18. And again, and then we saw 2018-19 market started going down, or the mid cap and small cap space corrected. And in 2019, we got the chance to start deploying actually some of that cash. And by the time we reached March, we were left from 30%, we were left with about 14 or 15% cash, which
Okay.
really played to our advantage when the markets crashed, because we could deploy that cash meaningfully in some good opportunities that we were getting at that point. So that's how we That's how we did sail through the March-April period. Also, the fact that I think we were invested in the foreign markets since 2000, since the fund started 2013, that has also kind of helped us, because we really thought a lot about these companies since the beginning. So we've been holding a lot of these companies for years now. Look, Google and all have been there since the beginning, since we started. So these companies obviously did well in the foreign part of the portfolio, did well also in this part. So these two things have pretty much helped us sail through this last few months.
Okay, when it comes down to foreign stocks, do you consider only US based stocks or do you also consider stocks from other countries and exchanges?
So our mandate allows us to go anywhere in the world,
Okay,
but we are restricting ourselves to North America, uh, Western Europe, and developed Asia.
okay,
Now, the reasons for these are that we want the minority shareholders, being minority shareholders, we want a good, strong legal system in these countries where corporate governance is good and we are comfortable with it. So going to too many exotic places, going to China, Russia, might not be in our best interest also, because if something goes wrong, we've seen over history that these companies can be nationalized or can just be shut down or be taken over. So we're not very comfortable going to such countries where we're not sure about the corporate governance standards. So we want the highest corporate governance standard because we are managing public money. Now we don't want that money to be in any danger or to give us sleepless night. So these are the places: developed Asia, which is Japan, pretty much, Western Europe, and North America give us these opportunities. We're comfortable with that. Also, the fact that we want our the communication that's got to us in English language reporting. Uh, so mainly we will invest in the US market, because a lot of the companies, even world over, are listed in the US in terms of ADRs and stuff like that. So we hold a company called Suzuki, which is the parent of Maruti.
yeah.
So we've not bought in the Japanese stock exchange. We bought ADRs in the US. So when they're listed in the US, there's a certain reporting standard that they need to follow, and we need to get everything in English language. So that is also very important, because we don't want to waste time translating, and you know that you get lost in translation, as they say, right? So these two are the factors that keep us only in these geographies.
And when you look at the portfolio right now, when it comes down to foreign stocks, it's mostly technology stocks in your portfolio, right? So when you look at filtering out stocks for your portfolio, did you consider only technology space as a sector because it was growing, or did you have a portfolio of different companies to shortlist and look at, and then these are the companies that you have arrived at, as a final shortlist?
Yeah. So what happens when we have when our maximum allocation to the foreign stocks is 35%, and because of the 65-35 model,
Yeah,
and in reality we stuck to about 30%, 32% is what we are stuck to, for the simple fact that if there's appreciation in the stocks, it'll go to it, 3% is the buffer that we require, right? I mean, because if you're fully at 35% and the stock starts appreciating, and say if the Indian stocks don't appreciate that much, then we breach that 35% limit and we'll have to start selling the foreign stocks. We don't want to sell our foreign stocks. So we keep it at about 30-32% allocation. But that means about I mean, if we have about 20 to 25 stocks in the portfolio, that's about on average 5% allocation to each stock. So that's about 5 to 6 companies we can choose from in the US markets, right?
correct.
And within that, we choose what's the best opportunities available to us. And at this stage, we surely think that the companies we have, at least the Amazon, Microsoft, Facebook, and Google, they deserve a place in the portfolio compared to maybe some other companies. But over the years, we've got everything. So we recently sold Nestle, which is a FMCG company. We've
Yeah,
got Suzuki, which is a auto company. We had Anheuser-Busch, which is in the alcoholic beverage space. We had BAT, which was British American Tobacco. So we've had other companies also, but at this moment we think that these 4 5 companies give us the best. We are most comfortable with this allocation at this moment.
along the lines of allocation, when you allocate capital among different stocks, when we look at PPFA's portfolio right now, it's quite concentrated when we compare it to the other mutual funds in the industry, right? And I guess partly because of that, you've also performed really well in the last 7 years in comparison to an average mutual fund out there. But what is your reasoning behind a concentrated portfolio in the portfolio holdings that you have right now?
Yeah. So again, we don't like extremely concentrated portfolios of say 10 companies or 8 or 10 companies, and we don't like it overly diversified or what you call diversification of more than 50, 60 companies. I don't think that does much for your portfolio. What there have been studies which show that post the 17th stock in the portfolio, the benefits of diversification start to diminish. So we think about 25 stocks is a ideal diversification for us. For the simple reason is that we can then meaningfully deploy money to some of our best ideas. We can meaningfully deploy to them. If we have 50, 60 or 100 stocks, that probably means 1% allocation to each stock. And that means that even if your stock doubles, it's not going to really do anything in your on the portfolio level. So we want about 25 stocks, and our top 10, 12, 10, 15 holdings or selection should have a good allocation at meaningfully will drive the portfolio up if they go up, and that's kind of where we stand.
Correct. I was actually wondering about something, and someone from Twitter had also asked the same question in one of the threads about PPFAS funds. Um, Basically, when all the other mutual funds out there are chasing assets under management and growth at any cost by introducing many new schemes, doing some NFOs, and also by chasing investors through marketing, how do you guys how are you able to stay grounded as a company and not chase the AUM growth at any cost, and also keep your fund very simple? I mean, you used to have only one equity value scheme until a couple of years back, right? Now you have a tax saver fund and a liquid fund. uh, in total you have like three schemes. What is the rationale behind having only one or two schemes? I mean, a very concentrated portfolio, and on top of that, very few schemes. How do you guys do this?
Yeah. So when we were starting the mutual fund, and before that we were a PMS, and we were also distributing third party products. It was actually, even as professionals, it was really hard for us to make a decision on what stock or what schemes are good or bad, or what are the differentiation between all these schemes. And it was more confusing than simple. One thing is that when we wanted to start a mutual fund, we said that we want to keep it a very simple structure. Okay, we wanted to keep a structure where we could uh, wherever opportunities are there in the world, or in different sectors or market cap, we should be able to take advantage of that within this one scheme, so the person can just allocate to our scheme, and know that wherever there's opportunities we will go. So it's something like, I call it a Swiss Army knife concept. Swiss Army knife is one instrument with multifunctionality. So
Correct.
similarly, with our fund, we wanted to keep it where we can invest across geographies, across sectors, and across market cap. And when we have such a structure, honestly, you don't really need to be in every category. And not that we believe in that, because in this one category, in this one fund, we can take opportunities from everywhere. Wherever there's opportunities, we can take advantage of that. Now, obviously, starting off with such a structure and not having multiple schemes is also comes with its own risk, right? I mean, if the fund is not performing, if you have one scheme and it's not performing, then you're not going to get allocation, and uh, it's going to be tough to run the fund. So I think one was, and you can't hide behind performance of another fund. So what we usually see is that if a fund has 30, 40 schemes, at a time one or two will always be doing well, and they market that. We don't have that advantage. We can't hide behind the performance of another scheme. So for us, it was obviously having conviction, number one, in what we are doing, putting our own money where our mouth was. So, and also having a lot of patience and running a very tight ship. I mean, that was very important, that, the first 5 to 7 years, you have to run a very tight ship. And even going forward, I'll have to run a very tight ship. because the costs have to be in control if you're only running one fund or a couple of funds, because all your revenue is going to come from one fund, uh, uh, and you're going to be a slave to that one fund. In terms of if it's doing well, you'll do really well, and if it's not doing well, you'll have to bide over that time by having enough cash reserves or any or reserves to go over the tougher times. So yeah, so I think patience is the biggest thing here, and having conviction in what you're doing. So yeah, so it's tough. I'm not going to say it's easy. It's pretty tough running just one fund.
Right. When you mentioned running a tight ship, I would essentially like to understand how your hiring process is like and what your relationship with your team is like, especially with such economic climate and regulatory compliances around your company. Hiring gets difficult, right? At your level, I mean, you have to go over a lot of day to day processes and also hire the best people to retain the fund's culture and quality. So, what is your company culture like, and how do you go about hiring people for it?
So uh, I think my relationship with my team is really good. I mean, obviously they will also have to tell you that it's takes two to tango. So from my side, I've got a great relationship with my team. At least the senior management has all been here for years. A lot of them have been here for more than a decade. So we all have been here for at least a decade or so. So it's more like a friends, family kind of a thing. Again, we are not a very salesy organization. I think my father, one thing he really believed in was to build the foundation of the company, build the culture really strong. And I'm so glad that he did that because it made my life easier. The culture is now set. We're not very salesy. I think we're a very entrepreneurial organization. So people, when we hire them, we want the entrepreneurial spirit in them, in the sense that you will be the master of your own person. You will have enough freedom and independence to do it the way you want to do it. There's no it's not like a school where there's a teacher who will tell you what to do. I think after the training and after the person's been with us for a couple of years, I think they automatically get ingrained in the culture. Again, we are not sales in the sense that only if it makes sense for the end investor do we make that. So I don't. There are no targets in my office. There are no sales targets or any of those things. Which people find it ridiculous that there's no sales target, but that's the way I think. Maybe the AUM won't grow that much, that fast, if you like. But I think what I'm looking for is to build a community of like-minded investors, and you want let it be small, but let it be sticky clients who will stay with you through thick and thin, basically, right?
Correct.
I think that is the kind of the culture which is pretty strong. And when someone comes into this culture, if they like this culture, I've seen that they stay with us, And people who don't like the culture will automatically leave. And let me tell you this funny thing is that over this 25, 30 years between me and my father running the company, we have only fired like 2 or 3 people in this whole time. Like
Okay.
maximum 5 people we have fired. We've not fired anyone, and those 3, 4 people who've been fired as because they've done some wrongdoing or something, which was not morally right and which we didn't stand for. But the fact that when you have a strong culture, I think automatically it weeds out the people who are not part of the culture, and they will automatically leave. So the culture will just get stronger and stronger. So I think relationship with my team is awesome, in the sense that I don't really unilaterally take also all the decisions. I mean, it's always a team effort. We all discuss everything together. We see what's the best way forward. At least we, again, as long-term investors, we also think long-term about our business. I mean, what do you want to be 5 years, 10 years from now? And let's get, I mean, what we are thinking, okay, 5 years from now, we'll be, say, at this position. Let's try figuring out stuff from now. Let's make those decisions right now so it will help us over the longer term. So it's a group kind of decision making kind of a thing. 4 or 5 of us kind of make the decision. Also, we have outside advisors who advise us. I think that's important to get outside perspectives on a lot of things, and they are trusted advisors. So we go to them from time to time if we get stuck. And these people can be from, they're not they're not always from the mutual fund industry. They're from other industries who we can seek them out and ask for their help. Hiring, honestly, sometimes with hiring, sometimes it's just a feel. You just feel that okay, this person will fit into the organization. It's very hard to put a pinpoint something, but I do want people who are motivated, who are motivated to work for PPFAS. Who who agree in the things that we are doing, because we're pretty different than others. We're not very salesy. So someone who's extremely salesy probably will not fit in only to our organization. So someone who is empathetic, who really cares for the end investor, uh, who's again disciplined, and also the fact that he can be adaptable. I think that's what I want. I want adaptability. Because things move too fast, and we need to keep adapting to changes. And as a smaller fund, we have to be extremely nimble. And sometimes the person has to take two or three roles sometimes. So if he's motivated to do all those things and not just work in a silo or in a box, and he's open to being an entrepreneur of himself, is some of the qualities I look for when hiring someone.
Got it. I'm actually curious about what a day in the life of a PPFAS employee is like. I mean, you invest or get out of positions very rarely because you like to hold positions in companies as long as the investment thesis plays out. So, what is the daily routine like in the fund house?
um, so again, buying opportunities happen once in a while, right? I mean, so
Correct.
there's not too much action in my office, right? How you see in movies, how the dealing room is supposed to be, ours is pretty chilled out, like that. So times like March, or when the market falls, that's the time that you're all in the dealing room and seeing stuff. But other than that, I think again, you can't keep. I mean, major buying will happen once in a while. It won't happen obviously on a daily basis. You'll have to obviously trim position, allocation, money comes in, money is going out. We have to do the cash management and a little bit here and there. But the action as such happens once in a while, if you're asking. But otherwise, I think it's a pretty normal day. I mean, it's not. Again, one thing I tell people is that, listen, you have to be happy at home to be happy at work. So if you don't have work at 5:36, please go home now. So one thing, I don't want people to stay very long at office or not have enough time at home, because uh, you have to be happy in office, because that's where you're spending most of your time. Right now, majority of your day is spent at the office. So you need to be happy at work, and you don't have that much time to spend with your family or loved ones, or on your hobbies or sports or reading or whatever it might be. Uh, uh, then one thing is that we encourage them to do those things. We have a library in our office, so sometimes people are just in the afternoon. Sometimes they feel like they'll pick up a book and they'll go to the library and read. So it's kind of an open culture, open organization. Collaboration is pretty strong, I would think, between all of us, and they're free to come to me for anything, or everyone is very approachable. So yeah, so typically it's not very frenzied, if I might say it.
Correct. When there is no action in the market, you guys usually go over the current investments and analyze them for their continuing potential and also do research for new opportunities out there, right?
Absolutely. I think one thing I forgot to mention is the learning culture. We always want people to keep learning and doing new things, and upgrading their skill sets. So that is one thing that's that's another thing that's something that we motivate people to do. And again, if they want to do any courses, and if they and the company is really happy to pay for them, or encourage them to do or upskill themselves. So again, so I am not in the investment department, in the sense we have a CIO, Mr. Rajiv Thakkar. So
Correct.
he manages the fund. I manage more on the business side of it. So surely they are always reading. They're always trying to get better. They're always. So I think that's one thing that I'm very happy about. That Rajiv and the research team, they are together, and they are always coming up with new ideas, or learning something new, or seeing that, okay, in the next 5-10 years, what are what are the things that will work. So they are constantly, even if there's no action in the market, it's there. It's always, they're always trying to learn something new, or set us up for the next 5 or 10 years. So it's not always about. So we barely see the screen, to be very honest, what the stock prices are. So it's all about once you bought it, and it's a buy and hold. So you don't need to obsess over those things. And we obviously monitor the investments and see if things have gone right or wrong, and we take actions accordingly.
Right. And you were mentioning about qualitative characteristics that you go over about a company and their management and everything, right?
Yeah.
And you also mentioned about talking to other industry experts. My question is, when you pick up a stock, it's arrived at your final short list, and like let's say, of 100 companies you want to study before finalizing the 20-25 companies to invest. When you have done your quantitative research and you want to actually research on the qualitative aspect of the company, do you talk to industry experts regarding that particular company's sector and gather details about the trends and where the industry is going right now?
Surely, I mean, I don't think we do that too much for the bigger companies. Like, honestly, if we have all the big tech, I mean, it's not like we need to ask too many people. I mean, we do obviously have our connections, say, abroad, other people who are managing funds or managing, who are interested in the value investing field. So we obviously talk to them and exchange ideas. But with the bigger companies, there's not much. The information is already quite out there. It's mainly for the smaller companies where you need to go talk to the supplier, talk to the customers, do some scuttlebutt kind of thing. Uh, yeah, so I think for the smaller companies, you would go much deeper into, okay, is everything fine? The bigger companies, information is fairly well available.
Makes sense. When it comes down to small cap companies that you want to invest in, whenever the
Hmm.
action happens, like March 2020, how do you make sure you're getting the price that you want to pay for acquiring the company's shares?
I think most of it is just about waiting and having such opportunities that come your way. Like a demonetization will happen, or sometimes the border tensions happen where 2-3 days the stocks are down and out, and or a ILFS kind of a situation happens, or recently the COVID situation happens. So we wait for something like that. So, for example, when we are buying pharma stocks, we will buy a pharma stock we like it only when the US FDA something happens with that. When the warning comes, the stock price falls, and that's when we buy it. So it's all about waiting and having a price that we are comfortable paying for. So a lot of it is just about waiting. I mean, waiting for the right price to come. So not be too greedy or too anxious about just getting that to it. And there are investments that are missed also. It's not like we always get a price and we are like, okay, if I just bought a little higher, it would be fine, because over time it went up. But sometimes it's just a discipline that we follow, and you win some, you lose some, I guess, right?
Yeah, this might be a naive question, and I have no idea regarding this. And I think a lot of retail investors also might have no clue. How does a mutual fund actually buy and sell stocks? I mean, do you have your own broker to deal to get you the fills from the market, or do you do it yourself? What is the process actually?
So, so we have a dealing team, but we're not allowed to make our own trades. We have to give trades to outside brokers.
Okay.
Now, we have to be empaneled with multiple brokers, because one broker can't get more than 5% of my business. So
Okay.
essentially, you need a minimum of 20 brokers giving 5% of your business to each of them. So there's no front running or any of those kind of things. So everyone doesn't know. So you can't just give one broker majority of your business, because he'll know exactly what you're buying, selling. So
Correct.
it's well spread out. No broker will get more than 5% of the business, and that's by regulation, not for us, but for every mutual fund. So when we decide on a buy or a sell transaction, we'll distribute that order to different brokers.
Okay, so those brokers will execute the orders for you?
Yeah. So yeah, exactly. So it's on Bloomberg. Usually it's on Bloomberg now, and sometimes on a phone call, which are recorded lines.
Okay. And once you get the fills, all your purchases will come to the mutual fund account, and your customers can track the portfolio. And how do these actually get converted into how do you calculate the NAV value, NAV?
Mm, Sorry. So
Okay, I'll
uh,
rephrase the question.
yeah,
All right. So you mentioned you had 17% cash position by March, right?
yeah,
Let's say you bought ITC during the March lows with that cash. And when that ITC
yeah.
purchase, the number of shares actually come into the mutual fund account, how does it actually affect the NAV? I mean,
Mm.
how do you recalculate the NAV, and is there a sort of process you guys follow for that?
Yeah. So anyways, calculated on a daily basis at the end of the day. Once all the buying, selling, everything is done, then you'll have your net position for the day. So from 13% cash, you've gone to 10%. So you're basically 90% invested in stocks and 10% in cash. So that all is put together at the end of the day. What is the exact situation? which will be divided by the number of the NAV is calculated by dividing that with the number of units. It's a formula where you just plug in, and again, we don't calculate our own NAV. We need to have a fund accountant who's a third party who we have to who will calculate the NAV and will be checked at our end. Only when the two match, when the NAV matches, then we will release the NAV. And on a daily basis, we have a cutoff time that we need to release the NAV by. So I think we have, I'm not sure now with the COVID exactly the time, but I think by midnight or something, we need to generate the NAV. And if it's wrong, then we have some time till the next day to recalculate it and make a revised NAV. If the NAV is wrong, then we will have to compensate people for the wrong NAV. I mean, over 7 years, probably happened, I would say once or twice. I mean, again, it would be a very small error or something, and wouldn't really make that big a difference, because it's a big error, we would definitely catch it. But sometimes small error of entering something or some human error might happen, but it doesn't really happen. I mean, like I said, over 7 years, probably happened once or twice, maybe.
Makes sense. One of the questions that I got on Twitter regarding mutual funds and investing, when I mentioned about this podcast with you, was people asked me to ask you what your take on passive versus active investing is like. I mean, your PPFAS fund is an actively managed fund, and then there are passively managed funds and passively managed investment vehicles like Nifty 50 ETF or an ETF for a mutual fund that tracks similar indices. So what is your personal take on passive versus active investing and your approach to it?
Yeah, so I think number one is we are in a very nascent stage of a market. I mean, what 3-4% of the population invest in the stock markets or in mutual funds. So the number is very, very less. Compared to 67%, 60 to 70% penetration in, say, developed countries, or even higher. We are at about 4% penetration. So number one is we need people to come into the market and invest in mutual funds first. Now, passive and active, I think, is a secondary question. First, you need to financialize their assets first, or their savings first. That's the main thing, which is happening, but it's a long way to go. And I believe that there's a place for both passive and active. So people who just are fine playing it safe, then they should go with the index fund or the passive funds, where costs are also low and you will go as the market goes. But I do believe that there's still a lot of how do you say it? A lot of space that is there for active management to outperform and create that alpha. So I think we are of the feeling that active we can generate better alpha than passive, but both are fine. I mean, I think it each depends on your risk-taking ability. It depends on what you're comfortable with, and I think there's a space for both of them. So each to its own, to be very honest.
Okay. You have a strong background in economics and business. On the lines of what you mentioned right now, that India has only 3 to 4% penetration of mutual funds in the population. What are your recommendations or suggestions to, improve this to a developed country level?
I think it'll happen slowly but surely. I mean, there's no one big jump that's required. First is having basic stuff like bank accounts, demat account, banks account for one. So again, now with the in the last few years, at least a lot of people are having bank accounts, and uh, uh, again, financial education is one thing that's absolutely required,
Correct.
which is not there. So I think financial education, having bank accounts. Again, I think even it goes with the mutual fund, having transparent communication to people. Again, we have this mutual fund Sahi Hai campaign that's gone on also, which has helped people come into the fold. In the end, it's the stock market, and sometimes, I mean, if you've seen the last few months, if people don't have a good experience, or you start and if people start only comparing point-to-point returns, and if in March you have seen 5-year return, it would be very bad, but today if you see 5-year return, it will be much better. Again, I think that communication has to be absolutely clear. Expectations need to be set right by the industry, by everyone who's involved in this. So I think it's a group effort by everyone to continue building this. I mean, it'll take time. And it'll happen eventually. I think people are getting more mature. There's a lot of material out there. There's a lot of course material, or people are study material or reading material, which is out there, and people are reading it. And I think once only when people start getting comfortable and having a great experience in the fund industry, will there be the word of mouth will become stronger, and that will only take the market higher. And again, like I said, financial education is must do for people to at least know what is a mutual fund. I think a lot of people don't even know what a mutual fund is. So education is to the core of everything, I think.
Makes sense. Along the lines of education, I was actually reading your annual report last week, and I found it very educational and also very insightful in terms of the content that you provide. I think it's kind of up there with the level of Howard Marks memos and Warren Buffett annual letters. Uh, Other than this annual report, what are the kind of initiatives that PPFAS is taking to educate retail investors?
Yes, I think knowledge sharing is important, and having transparency in communication is very important. I think actually what we have seen as a smaller fund house is that just, I mean, having great communication and transparent communication with your unit holders will be the most beneficial thing. I mean, I don't think people don't want to be sold dreams. They want to be told what is in reality, what is going to happen. For that, we have AGMs for our unit holders, which is very well taken. I think what it does is that it creates sticky client, very loyal client, because they are able to ask us any question under the sun at those meetings. And people have a lot of questions, and they want to be answered by the top management where they're investing. And we put ourselves up for scrutiny of our unit holders, and we live stream it also. So again, that whole is a big educational thing for a lot of people. If 5,000-6,000 people are watching it, and the question that people are asking us, and it could be anything about the portfolio, about the company, about a sector, about the economy, or any of those things, about a mutual fund business, or how does it work. I think that in that way we give a lot of information out. Our fact sheets, we periodically write notes. We have this thing called the Financial Opportunities Forum. We have a YouTube channel where we put up educational material on sectors and whatever we think in the current situation will be helpful to the people, to the general public. So we do a lot on that front, actually.
Okay, are these AGM meetings published on YouTube or any other
Yes.
platforms?
Yeah. So we live stream it. And also the recordings are put up on our YouTube channel.
Okay, got it. So I've been reading recently about the uptick in terms of number of accounts, demat accounts that have been created in India since March 2020, and we've also seen a lot of inflow of cash to mutual funds and stocks since the March lows. For a new investor coming into the market who's predominantly wanting to start with mutual funds, what would be your advice to like how to approach investing in mutual funds? What kind of filtering mechanism should they have? And if they are going to invest in PPFA's mutual funds, what do you want them to know as potential investors?
Okay, so let's keep PPFA on the side right now. Let's just take into account a lay person coming into the market want to invest in a mutual fund. Let's first start with that. I think
Okay.
first and foremost is that don't think you're going to make a quick buck here. It's not a gambling den. It's not a trading den. It's for your wealth creation. So at least only put in money that you think will not require for the next 5 or 7 years. Number one is having patience, having a long-term approach. I think what I've seen is that people are very short-term approach. They see 1 year returns bad, or two, even for that matter, 2 year returns are not very good. They will take unnecessary action. I think one is that having, if you again, you have to go to a financial advisor if you're not savvy enough, or if you're savvy enough, then you have to decide on a fund that would cater to your needs as such. So uh, uh, it could be any fund, it could be any other fund houses also, and it could be prepared. It depends on that selection criteria. It would be uh, between you individually or with your financial advisor. The other thing is, if you're a first time investor, I would recommend you do a SIP and do it in that way. Regularly invest some in the market and let that grow over time. And yeah, don't be too trigger happy if some things are not going right for the last 2 or 3 years. remember you're invested for a very long term. So at least I would say as of right now, at least a 7-year horizon is necessary. And remember, stock market returns are lumpy. There are times when we've held stocks where for 4 years the stock has not done anything. But in the final year or the fifth year, in the 5 months, it's like more than double or triple. So you never know when you will get those returns. But the main thing is to be stuck, to be looking at this as a very long-term investment. Don't look at it as a short-term investment. You look at it as a short-term investment, most likely you're going to get disappointed.
Correct. So when it comes down to PPFAS mutual funds, what are the things that you want your potential investors to know?
Yeah, so I think our motto or what we look at is protect the downside and give a reasonable upside. What they need to know about PPFAS is that if there are opportunities are not available, and if it's a very go bull market, there will be times that we will be underperformers to the market because we might be a bit in cash or we're not chasing the fancies of the market. We are not doing that. We are looking at it from a very fundamental level where we feel the price is right. And in a extremely bullish market, you probably don't get the prices you want to be invested in those companies. So we don't mind having short-term underperformance if it helps for the long-term, if it helps for long-term performance. So our basic thing is that we don't mind slightly underperforming in bull markets, but we have to outperform in bear markets. So we are we're looking at preservation of capital as a very big thing. The risk reward ratio is something we're looking at, and we want to keep the risk as low as possible. And we want we want to give moderate, consistent returns, which will compound over time. So we don't want big negatives in our portfolio because, like 100 to 50, if the share falls, the 50% loss, but 50 to 100, it's a 100% gain. So the more you lose, it's tougher to get back to the normal level. So for us, downside protection is absolutely important. So we'll be very focused on these on this, and we will not have too many funds from our too many schemes from our fund houses. Wherever it makes sense or adds value, or if I'm excited to put my own money in this, we'll start a new fund. Until then, we'll continue doing what we are doing.
Correct. And when it comes down to people who are looking at retiring in the next couple of years or next 5 years, do you have any schemes in under PPFA's mutual funds that would support the goals of say somebody who is looking at retirement, or basically what's your advice in when it comes down to people who are looking at retirement, or retirement based investment approach?
So such people, I mean, again, like I said, we're an equity fund house, so we pretty much have equity products in this in Sen, and it's a quite a low compared to the industry, quite a low risk product in that way. If you see the risk metrics of the mutual fund, it's comparatively low. But I get your point. I mean, if it's a older gentleman or lady who wants to for a retirement planning, then probably should not invest very heavily in equity. They should obviously have some recurring income coming in terms of bonds and debt, or having a senior citizen FDs. I mean, their sovereign gold funds right now could also be pretty decent. So yeah, I mean, you probably need to look at debt or one of those kind of products, which will give you something on a monthly basis if you want, because equity probably not that much. So yeah, so they should be probably debt heavy. I don't have a product like that right now.
Got it. And when you say you go into cash during highs of the bull market, and when you sense that the markets are euphoric, do you actually literally cash out and sit on cash, or do you put that cash into investing in bonds and liquid funds?
Yeah, so we put into CBLOs or stuff like that, which will give us money market like returns, So it's not just lying in cash or whatever it is. It is into certain extremely safe overnight assets, in the CBLO type of stuff.
Right. So circling back to the money management topic, one of the questions I was asked on Twitter was fascinating actually. What is the capital requirement to start managing funds for other people, and what would be the best setup for such a venture? I mean, in the last few years, the minimum requirements, I mean, capital requirements for PMS as well as mutual funds and alternative investment funds, everything has shot up. And you can't meaningfully manage funds as an investment advisor with a power of attorney or something. So what would be your best recommendation for someone who is having a personal track record of managing his own money, and he wants to invest for his family and friends and then eventually other people's money? What would be the best setup for such a person, and what would be the minimum capital required?
So yeah, so like I mentioned earlier, that mutual fund minimum net worth criteria is 50 crores, and now for PMS they've raised it to 5 crores. So that's basically a regulatory requirement. So if someone doesn't have that, they have to obviously look at other options. And the other option, I mean, honestly, we were a PMS where a majority of time was spent on PMS or a mutual fund. So again, one thing is, I mean, I'm a very strong believer that this profession is all about trust. So whatever you do, you build trust with the people you want to invest, who your clients in that sense. I think trying to do everything as a wealth management in the beginning is also not the right way to go. I would think that concentrate on your core competency, whatever it might be, and try to be the master in that. And again, word of mouth marketing can be really good in this profession. I mean, if you if you give good advice, or you have a differentiated way of doing things, and people start talking about it, that's the best way to go about it. So it's going to be a struggle in the beginning to make money. Let's put it this way. I mean, you have to be ready to struggle for the first 5 or 10 years, I believe, if you're a lay person trying to start a wealth management outfit. So I would think this is the way to go. But yeah, I mean, it's all about creating goodwill and trust, and go from there.
Makes sense. And in your case, you started as the vice president of PPFAS mutual funds back in the 2000s, and you eventually became the CEO. During this transition, what are the kind of challenges that you faced in the management aspect of the company?
So again, very in a very unfortunate, I became a CEO because my dad passed away, and that's what I took over the reins at that point. So honestly, in the beginning, I didn't have time to think because it happened all of a sudden. And I guess when it happens all of a sudden, then there's something. I mean, you just have to adapt to the new changes and just go do the best you can.
Correct.
Like I said, having people around you can trust and you can ask for seek advice is very helpful. I don't think I could have done it just by myself. And listen, I mean, it's been 5 years since that incident has happened. So I'm still learning, still making mistakes, and still figuring a lot of stuff out. So it's a day-to-day thing. I don't think you overnight from a VP to a CEO, overnight you're going to make great decisions, or going to become. It's about every day is a learning experience, and you try to be humble about it. You try to seek the people you trust. Uh, I think it's important to differentiate between people who want the good and people who don't want that much good. So again, it's about who to trust, who not to trust in that way. Yeah, I think honestly, it's each one's own journey, how you go about this. And for me, it was just happened all of a sudden. I had to adapt very quickly, and uh, yeah, and having people and a good team around you is very important. I was very blessed by that.
Yeah. If you hadn't come into PPFAS as a vice president, and if you hadn't come into investing field as such after you were done with your masters, what would you have rather done? I mean, what kind of career would you have chosen?
Yeah, so I think at that time I was pretty much also interested in sports management. I'd done some courses to that effect. I wanted to get into the sports space and the sports management space, and I took some courses. But eventually, yeah, I mean, I'm still very interested in I'm a sports fanatic right now. But yeah, that sports management. Would be something I would be interested in if I wasn't doing this.
I heard that you are also an avid golfer. Did you professionally train to be a golfer, or was it just a hobby?
No, no. So my dad and mom used to play, and while we were growing up, my father was a very avid golfer, and he had polio, so he couldn't. He had a bit of a limp in his leg. So Unfortunately, he was a big sports lover, but unfortunately he couldn't play many sports because of his condition. And
Okay.
golf was one sport that he could play like from beginning until the day he died, kind of a thing, right? I mean, and you could play that till you're 90 years of age. And so that he loved the play. He played that game. He loved to play it. My mom started playing later, and then me and my brother, my dad pushed us to take course, to take some course when we were what, I was in the sixth standard or something like that. And me and my brother did that, and we fell in love with the game, and yeah, and been playing ever since.
That's great. Uh, in terms of COVID related work, how are you managing things when employees are working remotely? I mean, in person interactions are quite different from online interactions, and remote work, the transition from in person work to remote work. How are you handling the transition? How do you, like manage to keep the operations running smoothly when this transition is happening?
Yeah, so I think we are lucky to be in this space. Yeah, I mean, I'm lucky to be in the mutual fund space where a lot of it was already
Correct.
digitalized and things are fairly easy. I mean, even if
Yeah.
you compare a mutual fund to a PMS, it's so easy. With the click of a button, you can invest in a mutual fund if you're KYC verified. But in a PMS, you would need like 70, 80 signatures, a lot of form filling, a lot of paperwork going back and forth. So, fortunate to be in this industry where, again, since the beginning, we were concentrating
Okay.
on the digital mode, and also at the fact that we were supposed to also do work from home if something goes wrong, if there's a terrorist attack or bad monsoons in Mumbai. You don't get to go to office or you can't go to office, and how would you manage it? So, the regulators already had kind of uh, uh, encouraged us to do that, and they would encourage us to work from home and see if you're stuck at home, then can things get normal? Can day-to-day activity be proper? So there was some training on that effect. Again, systems were really strong in what we are doing right now. So I mean, after the first actually month or so of just adjusting to the new changes, I think operationally it's been pretty good. I'm very happy and very lucky to be in this industry. Again, not meeting people face to face is again was a challenge in the beginning about collaboration and stuff like that. But with Zoom and Google Meets and all these things, it's fairly easy. So I mean, that's also become like a new normal now, where I think things are moving along pretty smoothly. So I think after the initial adjustment period, it was actually pretty smooth for us.
Are you looking at embracing this remote work culture going forward majorly, or are you looking forward to coming back to offices and meeting people in person? I mean, what do you think is the future of work-related industry right now? I mean, in mutual fund industry at least, do you think people would embrace this remote work culture going forward, ditching office spaces and ditching the transit and all, or do you think people would prefer to come back to offices?
Yeah, I think it'll be a flexible kind of a model, at least from what I'm thinking going forward. Yeah, there would be flexible. I think now we know that work from home can happen, and we can. People are used to it, and it's not looked down upon. So if you're working at home, your wife or your husband's not going to tell you, "Oh, what are you doing at home?" So it's kind of something that's acceptable now. Uh, Again, I would think there would be a flexible model. You still need to for a lot of the functions you will still need to come to office, but I think flexibility will be there of a day or two working from home. I think that'll be the model going forward, at least for an organization like us, where again a lot of people spend a lot of time commuting, back and forth. Some people are taking 2 hours coming to office, 2 hours going back to office, and that time we find that productivity has actually increased for those people in this time, when COVID time, where they can stay at home and be more productive and save so much time. And the hassles of the local train getting pushed around in the crazy crowds in the rains. So for those kind of people, it'll be different. It'll be different for different people and different functions. So a research person would be better off probably sitting at home and having his own room and concentrating, and come once or twice to office maybe. I'm just throwing it out there. I don't know exactly what's going to happen. But sales team or operations team might need to come to the office much more. So it'll depend on the function you are at.
And I heard that you're an avid reader. What kind of books do you enjoy? Also, do you have any personal recommendations of books for people in this industry?
Yeah. So actually, uh, my reading has come down quite a bit actually after I've got a daughter and she's 3 years old and with work from
Yeah.
home, uh, taking care of office plus the daughter because my wife also works. So the reading has been slow, but I do enjoy reading autobiographies. That's kind of my in non-fiction. That's my favorite genre. Reading about people. It could be sports people, politicians. Industrialist or whoever. So autobiography is something I'm interested in. And in fiction, I like Jeffrey Archer, John Grisham, James Patterson kind of things. Kind of authors. So that's kind of where it is. But yeah, I wish I could do more reading in the last few months though.
Okay, if you were to recommend only three books to someone, which three books would you recommend?
Recently, I read Shoe Dog, which is of Nike. I really like that one. That's really good. And yeah, some of the other autobiographies. Like I said, I'm very interested in sports. So I read a lot of sports autobiographies. So the Open from Andre Agassi and Tiger Woods, because I'm a golf player. So Tiger Woods autobiography. So some of the things that I like are those.
Okay, got it. So, thank you so much for being on the show, Mr. Neil.
Yeah,
Thank you for spending some time for this. It's been a pleasure talking to you today. And I hope, like me, everybody else listening to this podcast gain some valuable insights out of this.
perfect. Okay.
Thank you once again for coming.
Thank you so much. Thank you so much, Raman. Appreciate it.